Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Pantheon Resources PLC. Please note, you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome David Hobbs, Executive Chairman, and Jay Cheatham, Chief Executive Officer of Pantheon Resources PLC, which trades on the OTCQX Best Market under the symbol PTHRF and on the LSE AIM Market under the symbol PANR. Welcome, David and Jay.
Thanks very much. Yeah. It's good to be here with you, and thank you all for joining us today. I'm going to quickly put a disclaimer up, which I urge you to read at your leisure. It'll be in the slide deck that you can access later. So, who is Pantheon Resources? That's going to be answered through the lens of who's running the company, where the company is, and why the company is doing what it's doing. Jay is our Chief Executive Officer. He'll be speaking subsequently during this presentation, but very experienced oil man and longtime CEO of Pantheon. Bob Rosenthal and Justin Hondris are the other executive directors of the business. And the key engine house of our activity in Alaska is the combination of Pat Galvin, who was a state commissioner, Michael Duncan, who's our operations vice president in Anchorage, and Tony Beilman, who's our senior vice president of engineering, are the people who make the magic happen. In terms of where we are, this is a significant play in a global super basin. The Alaska North Slope has obviously historically had some great days behind it, but it has great days ahead of it. Today, there's probably over the course of the next decade going to be some $100 to $150 billion spent on the developments of ConocoPhillips's Willow project, Santos and Repsol's Pikka Horseshoe project, along with Pantheon's Kodiak and Ahpun projects, and highly likely a gas pipeline to monetize the between 40 and 50 trillion cubic feet of natural gas, which will predominantly be exported as LNG, but quite a significant amount of gas used in Alaska itself to make up for declining production in the south. What you can see is that we are sitting right alongside and under the Trans-Alaska Pipeline and the Dalton Highway. So the way to be thinking about Pantheon's assets really is that we are in extremely cold West Texas. To really contrast with what else is going on, it's going to cost us between $120 and $150 million to get to first production, versus other developments to our west that'll cost an order of magnitude more than that just to get to first production. This means that as we drill out the field, we can do so one well at a time and use cash flows from existing producing wells to fund future development wells. And that's the reason for it being a very high return project between those two fields. If we move in to look a little closer, the two fields, Ahpun, currently being evaluated by Netherland, Sewell and Associates, and we estimate, the management estimate is around 500 million barrels recoverable, of which around 200 million recoverable from alongside the Dalton Highway. And the Kodiak asset, which Netherland, Sewell has evaluated and has recognized contingent resources of nearly 1 billion barrels of marketable liquids. All on state land, all too far south for polar bears, and without any obvious impediments to moving forward with development, and a very supportive state. If we look at that in more detail, what you see is Ahpun to the east, and that is the upper reservoirs. So everything that is in the shelf margin deltaic beds, in future maybe the slope fans, but also the Alkaid formation, which we've recently tested and we'll talk more about in due course. And then Kodiak, the western and larger field, deeper basin floor fans, but a giant accumulation. And our plans for this involve moving through to an FID for the eastern area of the Apun field by the end of 2025. That means getting all of the regulatory approvals from the Federal Energy Regulatory Commission for the tie-in to the Trans-Alaska Pipeline, from the state for their development approval, and again we'll mention that in more detail in due course. As we drill out initially the wells along the Dalton Highway, as I said, we see about $120 million to first production, around $300 million total of net cash outflow before we become fully self-funding from production revenues. And those production revenues will be used to expand the development into the western area of Apun, the area that is further away from the Dalton Highway. And in due course, with an FID targeted for the end of 2028 into the development of the billion barrel plus Kodiak field. As mentioned, there are some other discoveries which we don't yet incorporate into our development plans. If we look at how that then translates into our strategy, we have recently been very transparent about what it is we're going to do, and we're going to take it in a stepwise fashion with a target of demonstrating sustainable market recognition of value of between $5 and $10 per barrel of recoverable resource. In order for us to get that recognition, we think we're going to need to have around 20,000 barrels a day of capacity, around 10,000 barrels a day of straight run production being delivered directly into the Trans-Alaska Pipeline. And that is built around an initial development of 30 production wells, 10 injection wells from the pads alongside the Dalton Highway. So around 40 wells total gets us to that point. And of that, we will seek to maximize the amount of equity, the amount of non-equity funding, that we need in order to avoid dilution to our shareholders. So, as I said, first goal, get to financial self-sufficiency. That needs around 40 wells. To get to first production requires 3 new wells plus the use of the existing well as an injection well, and we estimate that'll be around $120 million. Kodiak will follow on, as mentioned earlier, growing ultimately to around 200,000 barrels a day. That's what we'll be sizing our entry into the pipeline to be able to handle at least. When we look at funding, it may sound like a lot of money to raise $120 to $150 million before you can be drawing down on reserve-based lending, but we're in discussions with vendors and off-takers and lenders in order to reduce that equity component to the minimum possible. And our hope is to be able to bring that down maybe to as low as $50 million of equity requirement. And we will be, over the course of the coming months, we'll be announcing those arrangements as we progress them, which is really the main next news along the way. But with that, I'd like to hand it on to Jay to talk more about the specifics and the operations.
Thank you, David. Well, this is a slide that was developed by, or the numbers were developed by Netherland and Sewell. And we've been working with them really for the last year on both the Kodiak, which is shown here, and our Apun development. And you can see they've given us a best estimate 2C contingent resource of, as David mentioned, just under 1 billion barrels of total marketable liquids. That's a combination of black oil, NGLs, and condensates. Now, we believe that the 3C estimate is the more likely estimate. If you've watched some of our previous webinars, you will understand why we believe that, in that Netherland Sewell was bound by the data from the Talitha A and the Theta West #1 wells and could not estimate any improvement in the reservoir quality going to the northwest, which we firmly believe will happen because of a shallower depth of burial. So what do we need to do to convert the just under 1 billion barrels from resource to reserves? Well, we need some more technical data. That'll probably require a couple of wells and longer term tests, full cores, more PVT work, and more samples of the liquids and the crudes and the condensates. A field development plan and regulatory permits, as David mentioned, we're working on those right now. SLB, formerly known as Schlumberger, is working field development plans. They have a more than 13 million cell dynamic model that they're using to do that. We need viable gas and water utilization or disposal methods. That's really pretty easy. It's a matter of wells and horsepower, and we can do that. We can drill the wells, and we will have gas that can run the power generation to give us the horsepower needed. The ability to market oil and NGLs. We sold 10,000 barrels of oil during our longer term test earlier this year. That did not include the estimate of the NGLs and condensates had we had a refrigeration unit. If you go back to the Netherland and Sewell numbers, that could have been as much as another 20,000 barrels. But we sold 10,000 barrels of approximately 40 API oil into the Trans-Alaska Pipeline. And we know that the NGLs and condensates produced further north go into the pipeline. And a commitment to fund and complete the development, well, we're working on that. And as David said, we're churning real hard to get on to that. So the Alkaid-2 well cost us about $34 million. Excuse me. We estimate that we can get that down to about 13 million with a lot of things that are one-time cost of drilling that well. The drilling time savings, we drilled a pilot hole, we came back up, we set a plug, and we kicked off that plug to drill the horizontal. In future wells, we will not do that. We will only drill the vertical portion and kick it off with no pilot hole and having to plug back. Frac optimization. Schlumberger had only one crew, so we were working 12 hours a day only. So we had several hours each day of startup and shutdown. Plus, they charged us a very large amount to pump chemicals we had sourced elsewhere through their units. The sand transport. We double handled this sand 4 times. In the future, we will mine sand on the north slope or somewhere nearby, and we will handle it only once. We'll use existing pads. As David said, we have one existing pad along the Dalton Highway. We will only do logging while drilling. We will not run the multiple e-logs that we did previously. And there are many other smaller issues that, not issues, but well testing, servicing, etc., mob, demob, that we will not have in development. And we are confident that we can achieve $13 million per development well in the future. Although we expect our first wells to cost us about $20 million each. Now, we issued an RNS, which is basically a press release this morning, that talked about the fact that our frac efficiency that we had on the vertical portion test of the SMD, excuse me, was approximately 50% of theoretical efficiency. Now, when we fracked our horizontal Alkaid-2, our 5,000 foot lateral, we estimated that frac efficiency at about 20%. So we had prognosed that we could get to around 1,200 to 1,500 barrels a day IP with a doubling of our frac efficiency and a doubling of the length. So we are now confident that we can reach those IPs and the EURs that we've stated, given the very good result that we've gotten out of the updated frac that we used for the vertical portion of the shelf margin deltaic that we just finished the testing on. Now, what are our major milestones? A development plan, pipeline right-of-way, hot tap, design and approval, and an air quality permit. The picture you're seeing is our Alkaid 2 pad. So we drilled the Alkaid 2 well from this pad. Along to the right, you can see the Dalton Highway, and the TAPS is just to the right of the Dalton Highway, the Trans-Alaska Pipeline. You can see just how close we are to the Dalton Highway and the pipeline. We are working on our unit development plan and our approval. We anticipate no issues, as David said, with the state to have that approval. We're not in an area that's highly environmental. The state pipeline right away it's about 1.5 miles from our lease to where we will hot tap into the Trans-Alaska Pipeline. You can see the location there in the background. The pipeline comes on the west side or on the left of the Dalton Highway at that location. Hot tap design and approval, we're in the process of doing that, hiring the engineering companies required to do that work. And an air quality permit, we anticipate no issues there because we plan to be zero carbon emissions. We will use our excess gas to generate electricity. We will have all electric fleets and rigs, and any CO2 that we are producing, we will re-inject into the reservoir, and water will go back into a shallower zone above our produced reservoir. So, as I mentioned, we're working with SLB to develop well level analysis and production forecasts, and the work that we've done on the upper zone with that 50% efficient frac just reinforces our belief in the development plan, and that's ongoing. We expect a final report in Q2 of 2024. Those will have both field level and individual well EURs and productions. We'll get P10, P50, and P90 production for both Ahpun, that's our eastern field, and Kodiak, our western and much larger field. So as I mentioned, SLB will use their dynamic model that'll include the gas injection and water well analysis. So the key, of course, is what can we sell into the Trans-Alaska Pipeline? As I mentioned, we sold 10,000 barrels a day into the pipeline previously. It's a common carrier. Access is regulated by FERC. NGLs have been and are currently transported to market by TAPS as part of the crude stream. And there is a quality bank where each input stream of North Slope crude is priced. And our current estimate is that our production from the Alkaid 2 would receive approximately 90% of the value of the published ANS prices. And I looked this morning for the ANS, and the spot ANS yesterday was just a little over $93 a barrel on the west coast of the U.S. If we back out $1.50 for tankering and the approximate $4.50 Trans-Alaska Pipeline tariff, that gets you up about $87 a barrel going into the Trans-Alaska Pipeline for ANS crude. If we take our 90% of that, we're about at $79 net back for our ANS marketable liquids. With that, I'll turn it back to you, David.
Thanks very much, Jay. So what you can see here is a schematic of the plan, and there are a number of steps along the way that get us to realizing the outcome. Some of them we've already completed, the delivery of the Netherlands Sewell report on Kodiak. We have received the tax advice on listing strategy, and we'll talk about that in the Q&A because I see there's a question there. We've found the location of our office in Houston, which is at advantageous prices right now because it seems a lot of people want to work from home, and therefore office managers are keen to attract tenants. We are in discussions around financing of the developments, and in terms of the next news flow, we're expecting now probably the Netherlands will report on the Alkade zone of interest I would expect the first quarter of next year, to be followed by the report on the SMD, which will incorporate obviously the results of the recent well test that we announced this morning. But in between those times, we are progressing discussions on financing, and of course we'll announce as soon as we have arrangements in an announceable form, which I would expect to be over the course of the coming weeks and months. Certainly we'll have more to say on that before the end of the first quarter of 2024. So there are exciting times doing an awful lot of boring things. And the key question that I know we get asked repeatedly is, why should I be invested in Pantheon? And the answer is simply that if we can achieve cash self-sufficiency that underpins then our position as a price maker, not a price taker, and we have a minimum of 1 billion barrels recoverable as already certified by independent experts, and an appraisal program leading up to the development of Kodiak that could well take us, as Jay says, towards those P10 numbers as our base case, then anyone can do the math and realize the gearing that there is from a $300 million market cap to whatever the outcome would be at 1 to 2 billion barrels and $5 to $10 per barrel. So with that, I'm going to turn it over to questions and I'll read them out. Some of them I think are probably for Jay, some for me. The first one I've got is if a potential partner were interested in taking on the project before your estimated first production target, would you consider it favorably? I think the simple answer to that is if the price is right, absolutely. But we are not looking to sell quickly. We're looking to sell well if we're going to sell. And we absolutely believe that the highest value will be achieved by moving forward with the development in the way that we are, bringing those resources to be self-financing, so that then it becomes a question of whether any offer that may or may not come is more attractive than the case for continuing to hold. There's another question that's broadly similar. So rather than doing that, there's a question. Given the outages of all AIM stocks and apparent short attack today, how are your plans progressing to list in the US? We're not particularly focused on the outages of AIM or anything on a day-to-day basis. Our strategy for the listing is based on longer-term, more strategic considerations. We have crossed the first threshold, which is that we've established that there isn't tax leakage in moving to any of the scenarios that we outlined in a previous webinar. One was to remain UK listed but on the main LSE. One was to have a dual listing but with LSE and NASDAQ. One was to be a foreign issuer on NASDAQ and the other was to be a US issuer on NASDAQ. None of those present an insurmountable problem, so we're into the next stage of assessing what is most advantageous in terms of access to capital and administration for us, and we're in discussions with investment banking advisors with a view to probably aiming to have completed whatever restructuring and relisting by the first quarter of 2025. There are some steps in that process that simply have a time to elapse for the steps to become effective, but we will be very transparent about what the plan is and what the timetable is as soon as we have it put forward. Jay, there are a few questions around whether the Netherlands Soul report has prompted more interest from external parties. Are people coming to the data room or not? Other questions about what seems to be the appetite. Maybe you can talk a little bit about what's going on there.
Yes, obviously we can't talk specifics, but the Netherlands Soul report has prompted lots of inquiries, and we have issued several NDAs to various parties. Past that, I can't say too much, but there's some very good people that are interested in coming through the data room. So yes, it has. I presume it was as a result of Netherlands Sewell.
It could just be emerging appetite. There's a question: when will our Houston office lease be finalised? Where will it be? Well, as you can see on the slide, it'll be at 2000 Bering Drive, which is out in the Galleria area. Are there issues with Theta West being left for what could be 2 years unattended in terms of deterioration of the well? I'm not sure. I mean, there is no issue with leaving a well suspended for a couple of years. So if that helps. Jay, will the pipe feed to the taps run from the current Alkaid 2 pad, or will a further gravel pad be constructed further north from which to drill closer to the hot tap junctions?
Actually, we plan ultimately to have a larger facility further south, but the first one will come from the Alkaid 2 pad up to taps, and then over time we will increase that capability with a larger facility further south along the Dalton Highway.
Great. Again, Jay, probably for you, is our plan to mix production from the various stacked reservoirs in Apun in the same well, or to drill individual wells into laterals in each of those stacked pays?
Right now, our plan is individual wells, but ultimately we may, as is done elsewhere, do multilaterals out of various wells. But right now, our plan is an individual well with a lateral. That doesn't mean that production won't be commingled at the surface, however, because that's very likely. We would have potentially some SMD or Alkaid wells from the current Alkaid pad, and potentially commingling the slope fans and the SMD and some of the further southern pads.
Another question around scheduling of the hot tap. What do we think the current timetable is, and what is the scope to accelerate that date?
Well, we've estimated it's going to take at least a year, and that dovetails with how long we believe we need to go to full FID, and which the end of 2025, and then be in production in early 2026. There really aren't any significant issues. We're just estimating that it's going to take that long to get through the FERC process.
And I think it's a generally true point to make, I think it speaks to a couple of questions I'm about to paraphrase, Jay. That we've tried to make sure that this works on the most conservative assumptions that we can make around timing and costs and delivery of well performance, so that we see upside in terms of the ability to accelerate to earlier than the spring of 2026 for first production, just as we see potential for an earlier commitment to development than the financial year ending, or the end of calendar year 2025. The two questions, one was, given the frac design for and the outcome from the SMD test, if we had used that frac design in the long-term test on the Alkaid zone of interest, what do we think we would have seen as an IP30 from the 5,000 foot lateral, and what can we say that would mean in terms of a 10,000 foot lateral? Jay, do you want to?
Yeah, so our IP30 on the 5,000 foot lateral, what we estimated as a 20% efficient frac, was 505 barrels of marketable liquids per day. If we had gotten a 50% efficient, my belief is we would have doubled it, maybe a little more than double. So we would have gotten something 1,010 or maybe even 1,100 barrels of marketable liquids a day out of that 5,000 foot lateral. And yes, if you doubled the length of the lateral, you probably would potentially have something up close to 2,000 barrels a day for an IP. And just as an aside, the Schlumberger is estimated 1,200 to 1,700 barrels a day IP, and the EURs are, as we've mentioned, well over 1 million barrels of marketable liquid. So it's very, very good news. Sorry,
is that well profiled? No, absolutely. Sorry, Jay. Is that well profiled, assuming no improvement beyond that doubling of efficiency and the doubling of the length that we've applied across the entirety of the portfolio to establish the $5 to $10 per barrel being a reasonable number? I'm not going to embarrass myself by trying to divide by 9 on the hoof. So if we said we had roughly 1 billion shares, what that's telling you is that at 1 billion barrels, the present value per share would be between $5 and $10 a share, and if we had 2 billion barrels, it would be potentially twice that. So one final quick question, which was, what's the case for owning the shares today rather than waiting until next spring or next year to own them? The answer is that when you've got a share that is currently trading at $300 million, mostly on the basis of people's skepticism about the ability to finance development without significant dilution, you may wake up one morning and find that that assumption is no longer valid, and the share price has shown that when it runs, it runs. Of course, anyone who wants to own shares with a higher cost base should wait and buy later, and anyone who wants to take the ride as it currently is should be happy to be a share owner today. With that, we've come to the end of the half hour. We're very happy to take any questions. I think people are aware that they can contact us through the website. Our new website is up today, so do go and visit that. It's been a labour of love, but it's been updated and hopefully better reflects everything that we've been talking to you about today. Thank you, Jay. Thank you.